Silicon Valley Bank. There's a good chance that before March you'd never even heard of it. So why is the collapse of the US's 16th largest bank such a big deal, and why is the government stepping in to save it? It comes down to three words: massive counterparty risk. Let me explain. You see, while small in relative terms, Silicon Valley Bank was hugely popular among startups, and startups are a huge engine of global growth. The global startup economy had created nearly $3 trillion in value before the pandemic, equivalent to the GDP of a G7 economy. Venture capital-backed companies employ 3.8 million people in the US alone. A disproportionate number of those companies banked with SVB, startups backed by giants of the venture world such as Andreessen Horowitz and Sequoia Capital. Banking there was almost a badge of honor that you had made it in startup land. In fact, almost half of all venture-backed technology and healthcare companies that went public last year did business with SVB. In other words, like when you have just one bridge to cross a river, it had become a single point of failure, or the aforementioned massive counterparty risk. So that's why when it started to look like SVB might not have enough money to cover all of its customers' deposits, there was such a panic. If startups can't access their capital, they can't pay their employees, server costs or rent. This wasn't just about a small regional bank. It looked like an engine of the tech economy might be about to break down.